Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. You know, I know a lot of traders, and I know those traders love their checklists. So today is going to be a checklist discussion. We're going to be talking about 5 numbers that an options trader should probably check before placing the trade. I think this is going to be an important discussion, particularly for those that might be new to options, but even for the veterans, it's a good reminder. A lot to discuss. Before we get to any of that, though, let me first of all say hello to everyone who's chatting in. Great to see all the familiar names. Great to see some that are new here. Hello, hello there, Jay Richardson, Marcus, Anna, Will, Richard, Lawrence, Eva, everybody else. Thanks for joining us week after week. We always appreciate your attendance, your contributions to these discussions. If you happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy the recordings. That's a great way to watch these webcasts, but you're certainly invited to join us in the live audience if you'd like to be here, if you'd like to be one of our live audience members. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern. Now, another thing I want to let you know is that my very good friend Mike Fairborn is joining us in the chats. Mike's going to be keeping an eye on any questions that come in that chat window on YouTube. And if I can't get to those questions, Mike's there to help me pick up the slack. Thanks for having my back there, Mike. Mike and I have worked together for a couple of decades now. So great resource to have here. Thanks again, Mike. Now, Mike and I would also like to issue an invitation to everybody listening to please do follow your favorite Schwab presenters on social media. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find and follow me on X at Cameron May CS. Now, as of a few months ago, you can also follow me on LinkedIn. So I'd love to see you there. If you reply to one of my posts on social media, I just try to reply right back to you. It allows for interaction when the cameras aren't on. But let's get into this discussion. Of course, as we're talking about options, that any real approach to trading or investing carries risk. And yes, that certainly applies to options as well. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. Yeah, I wanted to talk about these 5 key numbers that an options trader might want to consider. Check these numbers before placing a trade. So what we're going to do today is propose a quick, basic trade scenario. So today we're going to be putting ourselves in the shoes of a would-be long call option buyer. So we'll set a scenario using a chart. But before we place that trade, I want to walk through these 5 key numbers and where to find them, the implications for the trade, the sort of value that they might deliver to the trader, and then we'll place our trade at the end of the discussion. So let's get right into this. Let's go right to the Thinkorswim desktop trading software platform, and let's switch our chart over here to Walmart. Although PulteGroup is going to play an important role in the discussion a little bit later, the PHM chart that we were just looking at. So here's Walmart, and let's say that we are that hypothetical trader, and we note that Walmart has been stair-stepping its way higher. It's been running up and pulling back, running up and pulling back, running up and pulling back. And as of just the last 2 trading days, it looks like maybe Walmart's gaining a little head of steam again. And let's say that our hypothetical trader thinks that Walmart looks like it might push up to those previous highs, 135, possibly beyond. Obviously, it's not guaranteed, but let's say that's their trade premise. Now, what they could do with that information, we could go buy some shares of Walmart, or we might do an options trade. And so that's what we're going to be doing today. We're going to be buying a long call, which leverages this bullish outlook on Walmart. But we're going to talk through these 5 key numbers that the trader might want to check first. So let's start to make a checklist. Now, this is just an example checklist. It's not the checklist that every options trader goes through, but I think our veteran viewers of this webcast, our veteran traders of options in this audience, can agree these are going to be, as you see them unfold, going to be some pretty important information to an options trader to understand before placing the initial trade. So number one, what do you think it is? Probably every options trader might be a good idea to check this. The delta of the trade. What in the world is delta? Let me show you this. Let's go to our trade tab. Let's look at our option chain, and we can get into a contract here extending anywhere from 3 days out to 696 days. How about for the purposes of this discussion? Looks like just a basic projection. Let's say that our trader thinks that we're likely to hit that 135 level, at least before that March 20th expiration. How about we give it a little bit more time than that? Let's go out to the 17th of April for this example trade. And I'm not going to spend too much time on strike selection, but with the stock trading right around 127, how about we just look at the strike price that's closest to that? And let's say that our trader is contemplating maybe buying the 125 strike initially. All right. So how about we do this? Let's push this down a little bit. And let's say here's our example trade, which is we're going to buy a call. And for our example, let's say it's going to be, we're going to buy the 17th of April, the 125 call. And let's say we were able to purchase that. Looks like it's trading between 645 and 655. Let's say we're able to do that for about $6.50. That's the trade idea at this point. But before we go act on that idea, we're going through this checklist. Let's see, Eva says, Cam, before doing a cover call, it'd be good to check to make sure we're long. That's true. That's true. If we intend to be covered, we might want to own the shares first, Eva. In any case, let's talk about this concept known as delta. Now, when you first load up Thinkorswim, you may not be seeing these things called the Greeks, delta, gamma, theta, and vega. Instead, we might be seeing, I clicked on the wrong thing here, let's switch up over here. We might be looking at the last X, which means the last price, and the net change. So I'm going to click on the Greeks. Let's change the customizable columns here, and let's choose delta, gamma, theta, and vega from the menu. So what is delta, and what value might it provide to our trader before they place their trade? Well, it gives us two very important insights. Number one, it tells us the probability that our contract will retain any value at expiration. That seems like an important question, right? And that can be important whether we're buying or whether we're selling. The other thing that it might tell us is the degree of leverage, or in other words, the directional sensitivity of the trade. Here's what I mean by that. So let's explore both of those. As we look at the 125 delta, you'll notice that it has a delta of 61. First interpretation of that a trader, something that the trader might glean from this, is we might look at that in terms as a percentage probability. So just think 61%. 61% what? Well, for some traders, they use delta as a gauge for the probability that the contract will retain any value at expiration. In other words, that it will be in the money to any degree. So in this case, we might be able to say there's an approximately 61% chance that if we purchase this call, it will still retain some value at expiration. Now, this is not looking at the chart. It hasn't taken our analysis into consideration. Instead, it just looks at the volatility of the stock, how much time there is till expiration, and extrapolates a probability there. But that can be important. That's one insight provided by delta. A second insight, okay, delta, the probability is an estimate of something that may or may not happen in the future, right? 60-ish% chance that we expire in the money. Okay, great. The second application of delta is extremely accurate, and that is how much we can make or lose on our investment here if the stock moves up or down $1. So if you look at delta, think of the word dollar. Delta starts with D, so does dollar. What it tells the trader here, as they go to buy this call, for example, if the stock goes $1 upward, and we were thinking it might go all the way up to 135, that would be $8 higher. But just a $1 move might produce a 60-cent profit on this $6.50 investment. That's a 10% potential profit. That's a big deal. Now, I'm not going to give a lot of time to the other Greeks. They certainly are important. So what you may want to do, let me make a suggestion for you. If you're not familiar with the Greeks, first of all, if you're new to this channel, make sure that you're subscribed. You can click on the subscribe button down below the video right now. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube is where you can join these live streams like the one that we're having right now, or you can check previous webcasts in what we call the playlists. So one of the key webcasts that I would refer you to if you're new to options trading is part of a set of lessons that I put together to introduce those that are new to options. If you want a very structured approach to understanding this world of trading options, I put together a series of 10 lessons, and included in those 10 lessons was an in-depth discussion of those Greeks. So let me show you where to find those. So you go to our channel, you click on playlists, and then scroll down toward the bottom. That's where you'll find the playlist for this webcast series, Getting Started with Options. I'm going to click on View Full Playlist. And then I'm just going to scroll down through that list of previous webcasts until I see the word lesson. Okay, so just scroll down. It'll only take a couple of seconds, and all of a sudden you'll start to see the word lesson showing up on your screen. And what you'll notice here is that right here, lesson 5 of 10, so lesson 1 just starts trading options, building block number 1, understanding long calls, and I just build through what options are and try to bring that new trader along in a very structured way. But lesson 5 is understanding the Greeks. Tanya, you're taking notes? You're saying great learning lesson, take notes? All right, great. Hope that everybody appreciates these. But yeah, check that out. But let's go back to our discussion of delta. So we see, I think we can see the importance of checking delta. Number one, if we have that question, if I buy this, well, what are the odds that I just lose all my money? Well, there's only about a 39% chance that that happens. That's one use of delta. But number two is, well, what if I'm right and the stock starts moving up? How much money might I start to make? Another question is, what if I'm wrong and the stock starts to fall? So we could make 61 cents or lose 61 cents as the stock starts to rise or fall. Now, obviously, there are going to be some other variables to keep in mind. Those are those other Greeks, but you can see here which Greek has the largest number, which one might be, some people call it the king of the Greeks, maybe delta. So that's going to be number one that we check. Number two is, let me use an acronym. You veterans know exactly what this is, DTE. Others like, what in the world is DTE? Stands for days till expiration. In other words, it's how many days are on the contract. You notice with this one, there are 52. Now, that also is very important because if we go back to our chart, let's put ourselves back in the shoes of this would-be buyer of a long call. Let's suppose we had done the work to try to figure out where we thought the stock is likely to go. And in this case, we conclude that it looks like maybe over the next couple of weeks, maybe the next 3 weeks, it can go up to 135. And if previous advances sort of lay a pattern for what happens next, that's a big if, we don't know. But let's just say that the last few advances, if we behave like that again, if Walmart behaves like that again, this 135 may not be the top. It might go right on past that previous high, just like it did the last few times. So it might be 140, might be 145. Obviously, time will tell. It could go straight down from here. We don't know. But let's say that we thought it's going up for the next 2 or 3, or maybe, I don't know, 4 weeks. Most recent looks like it's been closer to 2 to 3 weeks. Well, if we then purchase a contract that runs out of time in 5 days, we might leave ourselves on the sidelines while the stock goes up as we anticipated. So the trader wants to check the days till expiration, number one, to make sure they have enough time to accomplish what they're hoping from the trade. And as a general rule of thumb here, for a long call or for a long option trader, a common approach, and this isn't the way that everybody does it, but they might project how long they think their trade period is, and then buy twice as much time as needed. So if we think, for example, that stock is about to go up for 3 weeks, maybe we buy 6 weeks. And that would take us right out to about April 17th. Now we could go for maybe a shorter term contract. This one wouldn't quite be, it'd be darn close to 6 weeks. But let's just say that we're going to use the 17th of April for this discussion. Now, I'm looking at this through the lens of someone who's buying an option, but there are certainly other traders who are selling options. And in that case, it may reverse the logic of selecting the days till expiration. In that case, with a seller, commonly the approach is to enter a contract with as short a time frame as they can get away with, while the premium that's being collected on the contract still appears adequate to them. That can be a bit of a judgment call. But Wiley's saying, can we throw a fib on there? We could, but yeah, like Eva said, we're probably not going to get into the sort of the weeds of technical analysis and just keep the discussion on options. This is a fair observation though, Wiley. And I'm tempted, you know I would be, but no, I'm not going to throw a fib on there. In any case, but for options buyers, the general concept here is they're trying not to run out of time. For option sellers, the general concept is they're trying to get time to run out as fast as possible, right? In any case, that is what DTE is, and it can be an important number to check. And it can tell the trader the potential impact of the passage of time. So give some insight into risk exposure, but also how much flexibility that remains in the trade. Let's suppose we get into this trade. We have 52 days till expiration, and the stock decides to just sort of pause for a day or two or three before advancing. Well, since there's still time on the clock, basically, there's still time in the contract, well, we still have some flexibility for the stock to move higher. We still have time for the stock to do what we're hoping that it would do. Or even if it retraces a bit, if it's going the wrong direction for a day or two or three, there's still flexibility within that remaining time for the stock to course correct and go in the right direction. On the other hand, if time's running out, the flexibility is no longer there, or it's really constrained. If a stock only has, or if the contract only has a few days left till expiration and the stock is misbehaving, now there's not much time to course correct and time is working against us. All right, so let's go on to our third number that we might check. And this is one, I think, again, our veterans are going to say, amen, Cameron, but that is the bid-ask spread. So what is this? Let's go back to this 125 strike. Let's look at these two key numbers, the bid price and the ask price. What are those? If you're new to trading in general, you'll see this for stock trading and for options trading. But generally, whether we want to buy a stock or we want to buy an option, whether we want to sell a stock or we want to sell an option, these are quotes that might tell us the prices at which we're able to do that. Now, the ask price is generally when we're buying something, buying a stock or buying an option, the trader pays near to, or pays basically the ask price or close to it. And when we're selling, we receive the bid price or close to it. So here's the way to maybe remember that. If we want to buy something from somebody, let's say I turn to Eva and I say, hey, Eva, I want to buy a call from you. How much are you asking for that? Well, she might say, hey, Cameron, I'm asking $6.60. And so I pay that ask price. Now, on the other hand, if I want to sell an option, I turn to my audience here. I got how many people watching? 217 people. I say, hey, I want to sell this call, this 125 call. Who will bid the most for it? And then I sell to the highest bidder. So we pay the ask price and potentially receive, when we're selling, the bid price. So that's important because, now, Greg, I can talk about that. Yes. Yeah. Because this bid and ask spread, you'll notice there's a difference between those two. They're not the same price. So if I were to buy this call right away, if I just paid the asking price, that would be $6.60 per share. These are standard contracts, so 100 shares. So that contract would actually cost me $660. And then if I got immediate buyer's remorse, oops, I just paid the ask price. I need to sell this thing that I just bought. Price hasn't budged. Nothing has happened. But if I sell it, wait a minute, I sell for $6.40 per share. That's $20 less. That's $640. I bought for $660. I sell for $640. There's $20 that I lost, or that our hypothetical trader here lost, without really anything happening. So we actually have a word for that. It's called slippage. And on some contracts, there's a little bit of slippage. On other contracts, there's a lot. So this, going back to Greg's question, does relate to something called open interest. It also relates to something called volume. But at its core, it just comes from liquidity. So let me give you a little story time about how options work, right? When I want to buy an option, there has to be a seller on the other side of that contract to sell it to me. When I want to sell an option, there has to be a buyer on the other side of that contract to buy the option from me that I'm attempting to sell. Now, the thing is, sometimes there is and sometimes there isn't. To provide for liquidity, to make sure that when we want to buy, there's someone to buy from, and when we want to sell, there's someone to sell to. There is an entity here known as the market maker. And their job is to line up buyers with sellers. And if there's a buyer who wants to buy and there's no seller who wants to sell, they step into that other role. And in doing so, they take a risk upon themselves. So with highly liquid stocks, it's relatively easy for the market maker to line up buyers with sellers. And if they're not having to take the opposite side, they can narrow those prices pretty close to each other, because the difference between those two actually represents a compensation to the market maker for the contracts in which they're stepping into the other side. They're playing the opposite role. So when there's good liquidity, you won't see much of a spread between the bid price and the ask price, because the market maker isn't taking on a lot of risk, even if they have to take the other side of the trade, because if they need to liquidate, it's not terribly difficult. When there's poor liquidity, we'll see a spread, a widening of that, which is actually just a greater compensation to the market maker for taking on a greater risk. They are getting stuck in this illiquid marketplace, and so they're compensating themselves with a larger spread between the bid price and the ask price. Now, at the same time, what that might also do is just slow down when traders recognize that there's poor liquidity. They might just be less inclined to trade, and therefore requiring the market maker to take fewer positions and take smaller risk. So that's it. It's a function of liquidity. Now, there are a number of ways that we might measure liquidity even before it shows itself in the bid and the ask price. Number one is illiquid stocks tend to have illiquid options. And so those stocks that themselves have poor liquidity, now Walmart is not one of those stocks that has poor liquidity on the grand scheme of things, but stocks that are poorly liquid will tend to have options with wider spreads between the bid price and the ask price. Now, another more direct measure is when we're looking at a specific expiration and a specific strike price. We might use something like, let's see, who was it that asked the question again? It was Greg, okay? Greg asked this question. Let's come up here and let's change this from our Greeks to volume and open interest. Looking at our 125 strike, there are two other numbers here. You get a bonus thanks to Greg. So now instead of looking at 5 key numbers, we maybe look at 7. But these are kind of related to the bid-ask spread. The first one is the open interest. So you'll see for this 125 call contract, 2,197. That's the number of current active other contracts that are currently open between a buyer and a seller. All right, so that's our open interest. Volume is how many contracts have been open or closed today. So 330. So this is today's activity. This is the ongoing open positions. Both of those can be an indication of relative liquidity. What do we notice as we go deeper in the money? Quite commonly, we'll have less liquidity. What do we notice as we go further out of the money? Quite commonly, we have less liquidity. And we'll see some widening of the spread relative to the price of the contract. So all of that, though, the underlying liquidity of the stock, the open interest, the trading volume on the option, all of those are indications of liquidity, but we can get a pretty good window in how liquid the contract is just by looking at the distance between the bid price and the ask price. And what some traders will do is they'll set a maximum there. What they'll do is look at the ask price, and if the spread between the bid and the ask is, let's say, more than 5% or more than 10% of that ask price value, then they might consider that to be too wide or an indication of poor liquidity. So in other words, we have a $6.55 ask price here. So if there were more than a 65, let's say a 32 cent to a 65 cent spread between the bid price and the ask price, for some traders, they'd say that's not very liquid. And in any case, they might just be looking for contracts with the narrowest spreads. So let me put this into terms. If we were to look over here at Pulte Homes, let's look at, or Pulte Group. Here's another stock that has been advancing in a sort of a stair-stepping pattern. Let's say that our trader has also considered looking at this stock for buying a long call. Maybe it's about to advance. And this one makes pretty big moves. This is about a $12 move here. This was more like an $18 move right there. So possibly, could it be that we're about to go from 140 to maybe 155, maybe higher? Who knows? But let's go to the trade tab. Let's look at the at-the-money strike. So with our stock trading around 141, let's say our trader was looking at buying the 140 call. All right. So if we bought that call right now, about 870 bucks. If we got immediate buyer's remorse, sold right away for the bid price, assuming that we can get in and get out that quickly, selling for $760. That's a $110 immediate loss with nothing having happened to the contract just because of the liquidity. That's it. Can Be Done says, isn't that spread going to change down the road of 52 days? Slippage seems to be important if you want to sell within the next couple of days, right? It's likely to change, but it's also very likely to stay relatively constant to options on other securities. In other words, Walmart's options are very likely to stay more liquid than stocks like Pulte Group. Now, am I saying to trade Walmart options and to not trade Pulte Group options? I'm not saying that. It's not my job to render advice to my audience. But these are things that traders might consider. They might also look over here and say, look at the trading volume today. 6 contracts. It's the same expiration. We're still trading at the money. It's still a long call. The same strategy. And yet the liquidity is much thinner. Okay, so that can be an important consideration. Let's look at important consideration number 4. Are these helpful? Are we enjoying these? I think these can be a big deal. Let's go back to Walmart. Let's finish out our discussion here. The 4th consideration is how much can the trader lose on a trade? We've already discussed how much we might make if the stock is moving up or if it's moving down. But bottom line, if this thing just turns out to be a flat-out disaster, just a bad idea, and we don't do anything to course correct along the way, and it just hits its maximum theoretical loss, how much can be lost? Well, that is going to vary by the particular strategy. So what I did for today is I chose conceptually one of the most straightforward strategies, is buying a call. We could have also just bought a put. Those are both one-leg strategies. But when buying an option, the theoretical, I'm going to highlight that word, the theoretical maximum risk is the amount that we invest. So if we buy this for $6.50 or $650 for the contract, if this thing just completely blows up, the most it can theoretically lose is that invested amount. Now, when we're selling an option, or if we're getting to a multi-leg strategy, that can definitely change. So I'd love to sit here and tell you how much can be made or lost on every individual strategy and the math that goes into calculating those. That would take the rest of our time plus some. So instead, I'm just going to show you a little bit of shortcut. Instead, what we might do, let's say that we're intending to buy this 125 call, we just click on that ask price and let's create an example trade for just one contract. And as I go to click confirm and send, the system automatically calculates that maximum loss for us. And this is important for us to know. In this trade, let me do this one more thing. Let's set a limit price on this of $6.50. So it's in line with our original estimate here of $6.50. So if this trade fills and we spend the $650 and then the stock collapses and we just let it go and it hits expiration, expires worthless, that's how much can be lost. Now on the opposite side of this, how much can be made? With a long call, there is not a cap on how much can be made. As long as the stock keeps going higher, the further it goes, the more can be made on this strategy. So it has an infinite reward potential and a theoretical maximum loss of 650. So why do I keep saying this word theoretical? Why is it so important for me to say that? It's because things can change. What if I buy 5 contracts and then I sell out of 2 of them, but I still have the original maximum theoretical loss in my head? Well, that has changed now. What if the trader buys a contract and allows it to go to expiration and it gets exercised? What if the stock is, let's say that our stock is blasted off and it's up to 135 like we thought, and we get to expiration and we have the right to buy shares for 125. That's what this call would give us. We have the right to buy that $135 stock for 125. That contract would be exercised automatically on our behalf, and we buy those shares. Well, now we're owners of shares. We're no longer owners of a contract, and those shares have their own risk and reward potential. So that can change things. So just know that that the maximum loss displayed here is the maximum loss, as long as it's just a long call and we don't do anything else with it and it's not assigned or exercised. Okay, there we go. So that confirmation screen can just be a quick way, if we're not entirely confident that we've correctly calculated the maximum loss in a trade, we can click that confirm and send, make sure that it's adequate, and then we can actually calculate, for example, how many contracts we might want to commit to. So in this case, if we see, okay, we can lose $650, but I'm willing to risk, let's say, a couple $1,000, maybe we change that to 3 contracts. And as we click confirm and send, we can now see that maximum loss is about $2,000 plus some commissions. All right, so that's number 4. And so what I'll do here is I'm going to put the word theoretical because it's important, an abbreviation for it. Theoretical max risk or max loss. Now, number 5, and then we'll go ahead and place our trade, is where do we break even on a trade? Who can tell me with this, let's assume that we buy this long call for $6.50 as the 125 strike. If we allow this to go all the way till expiration, and I will say with options, when we calculate a break-even point, unless we're using, let's say, the Analyze tool, that break-even point always assumes that we've gone all the way to expiration. Who can tell me what the break-even point for this long call would be? One more reminder, it's the 125 strike, and we paid $6.50 for it. Let me help you visualize this, because this is an important thing. Let's, I'm going to make a little line here to represent, this is our strike, 125, okay? Let's say that our stock goes up to $130, and we hit, matter of fact, I'm going to have to recruit a little bit of extra space here on our chart. Let's change the right expansion settings. Let's go out 40 days instead of 20. Let me see if I can grab, yeah, there's our April expiration. So this contract goes out there to April. Change this to April. There we go, and I'm going to right click on this line, and let's Push that out till April. All right. So let's say that our stock goes up here to 130 bucks and we hit expiration. So if it helps to visualize, let's say that's what happens. We go from where we are right now up to $130 and we think, oh, awesome. The stock is now worth 130. We have the right to buy the shares at 125. I got a $5 discount at expiration. Let's do it. So we exercise our contract. We buy the stock for 125. We are able to sell it for 130. That's great. That's a $5 profit on the stock. But we paid $6.50 for that trade. Wait a minute. It's not even a break-even trade, even though the stock went in the direction that we anticipated. Where is the break-even point? Well, we need to be able to, if we're paying to buy the stock at a specific price, paying $6.50, we need to get at least a $6.50 discount on the stock. So a quick calculation would be we'd take our strike price, the 125, and add the 65 cents to it. So in this case, our break even is 125 plus 650. So the break even for this trade would be 131.50, assuming we let the trade get to expiration, right? If I reverse the math on that, well, if the stock is worth 131.50 at expiration, and I exercise my right to buy the shares at 125, I'm getting a $6.50 discount on the stock, but I paid $6.50 for that right up front. That's a wash. That's a break-even trade. So it starts to give us a picture. If we hang on to this trade all the way to expiration, we need to get above, in this case, 131.50. It's pretty close to there. That's close enough. That's the work that we need this to do if we hold this all the way to expiration. And with each strategy, there are going to be different break-even points for the trade. So could I go through the math of each strategy? Nope, I don't have enough time. But what we can do, let's see, just learn the strategy. And I always hesitate to say, just use a shortcut. That's why you kind of caught a little bit of a pause in my voice there. I don't want to say just lean into the order confirmation dialog box as we click confirm and send and say, okay, there's a break even. Well, that's nice. It's correct, but it doesn't tell us the logic of why it's the break even. So learn the strategies first so we understand why break even is where it is, but it can be a very important number in the planning of a trade. Okay, so let's see. I think I saw somebody say they're new. Great to see you here. And yes, this webcast is scheduled to be archived, placed on our playlists on the YouTube channel. I'll show you again how to find that, how to subscribe to the channel. But in any case, let's place the trade. Now that we've checked the delta, we know the probability of retaining some value at expiration. We can see how much we might make or lose as the stock starts to move. We see the number of days till expiration, sort of our window of opportunity and risk. We've checked the liquidity. We know how much we can lose overall in this trade, and we know our break even. Let's go ahead with the trade. How about, let's say that we're willing to risk up to $2,000 on this trade. I do want to check. Let's check just one more time. Let me hide my trade. I want to look at our strikes, and it looks like it's, right there, 640 to 660. The middle point between the ask price and the bid price is right about $6.50. Let's see if we can get it filled at that price. Actually, I say let's see if we can get it filled. I'm not actually going to send this order off because I won't be following it up on it in a future webcast, but I did want to show how to place that trade. So maybe what we'll do instead, we just quickly show the placing of the trade again. So we just go to our trade tab, type in our symbol, go to our selected days till expiration. We'll go to our selected strike and click on the ask price to create a buy order. Then we just modify the quantity for the number of contracts that we intend to purchase. Let's set our limit price in this example. Oh, it looks like we've maybe moved a little bit. Looks like the bid and the ask are shifting a little bit, and it might be a little bit more difficult to get an order filled. But let's put that 650 halfway between the bid and the ask around the mid price. And we're ready to submit that order. So let's click confirm and send. Here we can see our break even. We can see the maximum loss of the trade. We can see the maximum profit of the trade. Both of those, again, theoretical. If we change the trade or if it gets exercised, that can certainly change things. There is a commission to be paid on this trade, then we just send that off. So Paul says, why not buy more time? That's a good question, Paul, because I do have a minute or two. I'll quickly address that. As I said, a general rule of thumb for some traders is they'll figure out how long they think the trade ought to take, and then they'll purchase at least twice as much time as needed. Now, that serves a twofold purpose. Number one is it makes sure that if the stock does what we think it's going to do, we have the time for it to realize its full intended potential. But number two is, let's say that we get that move in half of the time of the contract. Well, now the trader can exit the contract before time decay really starts to kick in, because time decay is a strong enemy of a long-term an option buyer. So buying twice as much time isn't so we can buy the stock and then hold on onto it for twice as long as not so we can buy the stock, but we can buy the contract and hold on to it for twice as long as we intended because the stock's just not doing what we thought. Maybe we want to give it more time. Nope. The objective there is to get in and get out before the real time decay kicks in. So if we buy more time, two potential problems there. Number one, more time is more expensive. That's one issue. Now the trader might be totally fine with that. But another issue is it might tempt the trader to be forgiving of a misbehaving trade. What do we need more time for? If the trader thinks that it's going to be a 3-week trade and we get a week or 2 or 3 into it and the stock hasn't done what we thought, guess what? It's not behaving the way that we thought it was going to, and the trader might just want to pull the plug at that point. It's obviously always up to them. But having extra time can lead us to make excuses for trades that just aren't doing what the trader thought. Right? Good question, though. Very good. In any case, time for us to wrap it up. But everybody, we've accomplished what I set out to do today. I wanted to go through 5 key numbers that a trader might check before placing an option trade. So there they are: delta, days till expiration, bid-ask spread, maximum risk, and the break-even point of the trade. So this is what we do on our Tuesdays. If you're new to options trading, I try to make these discussions as structured but as valuable as possible. And so I hope that you'll put it in your calendar to join us each Tuesday. Now, I also want to give you some suggestions for how to get the most out of your Schwab education. Number one is make sure that you are subscribed to our Trader Talks channel on YouTube. So the channel name is Trader Talks Schwab Coaching Webcast. You can subscribe by just going down below the video. Click on the subscribe button right now. It doesn't cost anything. It only takes a second. But this is where you can join our live streams. You can also find playlists of previous webcasts. You can even, if you want to, do a keyword search through those archives. So like earlier today, we talked about the Greeks and how we might want to watch a video about those. Let's just click on Greek. Let's just select Greeks. And here's a video that I made called Option Greeks for Beginners, Delta, Gamma, Theta, Vega, if you want to learn more about those. That's a quick way to sift through the archives. Now, another thing that Mike and I would strongly suggest is that you follow us on social media. So you can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. This is my profile. Make sure you're very specific with the spelling here, because there are lots of similar sounding, similar appearing handles, but mine specifically is at Cameron May CS. I'm very active on social media, and if you reply to one of my posts on X or also on LinkedIn, I try to reply right back to you. But that does raise the point that I'm also on LinkedIn as of just a few months ago. But I post here, and if you reply through a comment to one of my posts, I just try to reply right back to you as well. So that's if I get the question, how do I contact you between the webcasts? How do you reach out to your favorite Schwab presenter when the camera's not on? Social media is the answer there, on X or on LinkedIn. All right, well, thanks, Mike. Definitely appreciate your help in chat. Everybody, thanks for all the thumbs up. I see 173 people still watching the live stream. And as I refresh my screen, 70 have already clicked the thumbs up. That's very much appreciated. It sounds like applause to your presenter. That's the way it's received. But it also gives a boost to my video in the YouTube algorithm. It helps more people find these webcasts. So thanks for doing that. Always click the like button if you've enjoyed a webcast. I will see you in a future webcast. I'm also going to keep an eye out for you on social media. But everybody, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.